Ladies and gentlemen, draw in a hushed breath, because today's story begins not with reassurance, but with the sound of alarm bells echoing through the vaulted financial halls of Westminster. It is the tale of one bold decision, one sudden retreat, and the tremors that are now rippling through the UK economy. Before we dive in, don't forget to hit the like button, subscribe to the channel and leave a comment below. Tell us your verdict on this decision and what it means for Britain. It was supposed to be a moment of clarity. A point at which the government, under Chancellor Rachel Reeves, would signal to markets that it could shoulder the burden of the nation's finances, enact tough choices and restore confidence. Early hints suggested a plan: raise income tax, address the yawning gap in the public finances, send a message that austerity was over but discipline remained. Yet instead, the plot thickened. In recent days, Mrs. Reeves quietly shelved her proposal to raise the basic rate of income tax. Her team informed the independent budget watchdog, the Office for Budget Responsibility, OBR, that this option would no longer feature in the upcoming autumn budget. Markets watched. Investors blinked. The consequence? The pound slid. Government bond yields surged. Borrowing costs climbed. The very foundations of fiscal trust began to quiver. In short, the retreat sparked a crisis of credibility. Not long ago, it appeared inevitable: the government would raise the income tax rate to plug a massive black hole in the public finances. Multiple briefings suggested that ministers were braced for a historic move, a departure from the election manifesto pledge that pledged no increases to the basic rates of income tax, VAT, or national insurance. The OBR's forecast had painted a grim picture: weak productivity growth, sluggish wage growth and structural drag. Many analysts estimated the fiscal shortfall at around £30 billion or more. Markets interpreted the tax hike as the credible way to fill that gap. But Mrs. Reeves and her team pulled the plug. Instead of simpler and straightforward, markets were told the government would opt for hundreds of smaller measures to raise revenue. Threshold freezes, tax band freezes, stealth increases, the so-called death by 1,000 cuts. Yet each of these moves lacks the transparency and definitiveness of a headline income tax rise. As analyzed by watchers at XTB and others, the bond market recoiled. On the morning of the 14th of November, the story became public: Mrs. Reeves had decided not to raise income tax. The Guardian's live business feed described it as a U-turn and markets scratching their heads. The pound fell around 0.5% against the dollar. The yield on the UK's 30-year gilt jumped by around 12 basis points. Long-dated borrowing costs surged. Investors interpreted the decision as signaling that the government was stepping back from the hard choices. If no headline tax rise, then how will the multi-billion shortfall be met? The answer remained uncertain. Weakened credibility equals higher risk premium. That means higher yields, which means still more cost for the Treasury. A vicious cycle. First, borrowing costs. The prices of UK government debt fell as yields rose sharply. The bond vigilantes, those unseen guardians of fiscal prudence, seem to have raised their flags. Yields rising means the government must pay more to service its debt. Second, the currency. Sterling's retreat reflects an erosion of confidence in the UK's fiscal trajectory. Higher borrowing costs and fiscal uncertainty tend to weigh on the currency. Third, the political dimension. Labour fought the election on promises: no increases to basic income tax rates. Now the Chancellor appears to be circling around the edges of that pledge. To freeze thresholds is arguably a tax rise by stealth. To hike niche taxes is politically far easier, but might be less efficient. The public may sense the sleight of hand, markets certainly do. Finally, growth. If the government raises many small taxes, bumps up thresholds and penalizes certain sectors, growth could suffer. And in an environment of weak productivity and stalled wage growth, that risk becomes real. So here we stand, mere days from the autumn budget, with many questions unanswered. How will the remaining fiscal gap, now perhaps reduced to around £20 billion per recent improved OBR readings, be filled? Will it be through threshold freezes, subtle tax increases, spending cuts, or more borrowing? The Treasury is keeping tight-lipped. What message does this send to business and markets? Is this an indication of strategic nuance, or a sign of panic and indecision? Analysts suggest that unless the government demonstrates credible revenue plans, the U-turn could cost far more in market terms than the tax rise might have done in political cost. And crucially, at what point does the accumulation of smaller tax rises equal a headline tax rise in effect, even if not in name? Does the public accept such an approach? Will markets reward it? In the end, this is not a story about numbers alone. It is a story of trust, of expectations, of power, and perception. Mrs. Reeves and her team opted for a less visible path, but markets require visibility. When markets sense ambiguity, they leave a premium. Sterling dips. Yields climb. Confidence cracks. So tonight, I invite you to ponder this: is the U-turn a calculated choice of growth-friendly caution, or is it a signal that the government has blinked under pressure? Will the budget that arrives on the 26th of November restore trust or deepen doubt? Let us know your views. Do you think this decision strengthens the UK's economy or weakens it? Drop your thoughts in the comments, and of course, make sure you've subscribed for full coverage of the budget fallout.